And joining me on the podcast, but of course, it's also on video. We can see Paul, very smart there. I've got to say, Paul, I've not got the tie and suit nonsense yet because my office is freezing. I don't know what's happening, but the gas prices have slumped massively, but yet we're going through a cold spell again. I suppose that's forward gas, isn't it? People have, the Europeans have stored gas. So I don't know if you've seen the gas prices dropped off a cliff.
Yeah, well, I was actually, I know it's sad because I am that kind of person, but I was actually working out what the retail price is from the wholesale price. And actually, if you work out on terms of the where the break even is, we're just slightly above the £2,500 price cap, or that for average house, now using the wholesale electricity and gas prices, and it's falling. We're heading into the summer, and if you look at the futures price for the winter, it's no further anyway. I mean, admittedly, that's assuming a sort of like, we're still going to get continuous LNG from the US and from Qatar and places, and there's going to be no real pickup in China, which is a big assumption, and there's further escalation, obviously, in Ukraine. But you're exactly right. I mean, give it a bit of time. Once those forward contracts that our energy suppliers, those have rolled over, you should see, actually, I mean, it'll be obviously a benefit for the government because they haven't got to sort of subsidize us. I'm hoping actually they'll give us the choice to go on to, other tariffs rather than this fixed one at, I think it's 32 pence per unit or something like that on electricity, and about 11 or 10 or 11p on the gas side. If they allow us then to go for it, then we'll have a lower price as well. So yeah, bullish sentiment.
Yeah, well, do you know what? I've had the market-wise, I've had an awful 12 months. Personally-wise, I've had an awful sort of month or so. But I see the narrative changing. I'm starting to see more bullishness out there. In fact, in the early morning podcast I cover top 5 most sort of read sort of stuff, things out there you should read. And the point number 1 today was the National Institute of Economic and Social Research was saying, it's unlikely the UK will go into recession. I thought that's the first time I've heard that for a while. Marginal growth. And you're starting to see this in America now. There's more chance for soft landing. The bears have had their time. The lows are in. I think the lows are in. And I've been scaling into quite a few companies, not gone massively crazy on it, because I think there'll be volatility. And also very interesting, I often track just where the indices are on a moving averages and its constituents of those indices, where they are on the percentage over 200-day moving average and below. Now, this time, it's very odd because normally we've seen past recessions, you've seen small macro cap stocks go in first, come out first. That's not happening. That is not happening. And I think there's a reason for this, but I'll ask you if you think.
Okay, what is the reason for it? Why do you think? Because I'm with you. Normally, you'd expect small caps to come out quicker.
Yeah. So it's basically the FTSE is about 76% of stocks are above 200. Even the 250 are around about 60% of stocks above the 200-day moving average. The AIM All Share Index, only 30% of stocks, 34% of stocks was above the 200-day moving average. So the majority is still below it. Now, I think it's this. I think it's because of the interest rates, the cost of funding, all that. So interest rates going. I just think it's a very hard environment to raise money. Now, AIM is largely an index. There are companies on there that are profitable. There's a lot of non-profit, pre-revenue companies. So I'm thinking just their prices are suppressed because, as we all know, there's been so many companies that pull placings or can't do placings or done placings really at horrible rates in some ways, been very costly to them, and so that's what I think it is. I just think it's I think that struggling to finance themselves. I
think you're right. I think there's definitely part of that. The other bit, not to sort of like discount either, is just the funds flow, because we've had a lot of sort of like, particularly heading into the year end, a lot of sort of like selling ETFs, passive funds, trackers. There aren't that many passive sort of like tracker funds in the small cap sector, particularly on AIM, because it's difficult to actually do the mechanics, where there's lots obviously on the FTSE 250, FTSE 100, and you've also got quite a bit of the overseas investment, particularly from the States, coming back into European assets because of the dollar weakening in January. So I think you've got just a bit of just natural fund flow and catch up. So I mean, all I would say is that I'm with you. I think the in terms of the US payrolls report on Friday, absolutely red hot, and it looks as though the consumer and the economy is lasting longer. It's got further sort of like juice in it going forward. But what does that mean? It means the Federal Reserve and central banks will be holding interest rates higher for longer, and we're actually seeing the bond market catching that expectation up. So there's actually now not much of the US yield curve pricing in any interest rate reduction in cuts now into in the US for 2023. So what you've actually had is a bit of a reset and a sort of like a dose of cold water on the bond market in the last week or so. But you haven't actually seen it in the equity. It's still ripped. So I would say the economy is definitely looking stronger for longer. But that probably means inflation is going to stay certainly in the services and in the wages. And if there's any structural problems in the labour market, that's going to stay sort of like firmer as well. So I actually think I'm a bit concerned about the back end of 2023. And also 2024, more specifically, what the earnings are going to be, because the US Wall Street is expecting $245 per share next year. And I think that's under risk, actually, just because I think if interest rates are going to stay higher, eventually that is going to have a lag effect on the US economy and is actually going to, compress particularly operating margins, because there's going to be less pricing power for corporates, but their costs are staying higher, and therefore you're going to get that sort of like pincer movement with higher costs, lower revenues, reducing margins, which will hit EPS for next year. So I think party on at the moment, but I'm a bit cautious actually for next year in terms of. But anyway, big news that. What have you been buying? I mean, wow, that is really because you weren't negative.
No, I was negative. I mean, like I said, even just looking at the all share index, right? It's now over the 200-day moving average. It hasn't touched that since September. When was that? 2022. So last time that was in a downtrend. So we are at a level here, and I do agree with you. I think we've had a sort of relief rally on the fact that the Fed saying now we're going to sort of start slowing down a bit on the interest rates. But of course, you still got the effects of those costs coming through to all the companies, which we'll get to see. So I think it will be. We'll have these exuberant rallies. Then you have earnings coming out, and you realize, oh, hang on, it's still hard work. And so you may have this volatility, and I think it may even go sideways for a while. But there will be a sort of trading range, I think, of rallies in there. So I mean, but 6 years back, right, I was determined to get a nice diversified portfolio, and I started scaling into micro caps, and I started doing very well. So I pretty much ignored a diverse portfolio thing, and I sort of revisited.
I love that. I love that strategy. This is what I'm going to do, but I won't do it anyway.
I got greedy because I did so well in micro caps. I thought, hang on, what's the point having sensible returns? But then, of course, you come to a bear market, and you're realizing, hang on, that's why, because you need less volatility in the market. So I've gone back to that and I've refined it a bit. And so I've broken my sort of portfolio or requirements down sort of to, big cap, mid cap, and I'm trying to, of course, get diversification across the sector industry as well. But big cap sort of mid cap,
third or something like that.
Yeah, well, I'll start. It depends. I base a lot of it on my maximum exposure, for example, of big caps at 10%, for the micro caps and what I call hope high potential stocks 5%. But so I've broken it all down to that. But the funny thing is, I'm finding it very hard. I've got about 4 in the micro cap space, but I'm finding it very hard to find companies at the moment that are rallying appropriately in the micro caps. I'm not convinced, or they don't have cash. And so I think previously I would have filled up those 2 sections straight away quite easily. I haven't now, and so largely I'm full up in my sort of big caps and mid caps, but not in the small caps.
So what have you been buying? Big caps, mid caps? Just to name a few.
Yeah, I'll go through them now. But also, I've been looking at momentum as well, and fundamentally looking at companies straight away. But I do a company pretty much every day, analyze the company, and then I look at the fundamentals. Then I look at the momentum, the chart and stuff, and that's key as well to what I've been doing since September. And I said the first one I sort of bought back in September was it was K3 Capital and Argentex. K3's sold, but Argentex I'm up 46.
Yeah, it just done brilliantly.
Yeah.
Just on that, let's just hit it, because they did have a trading update over the last 2 or 3 weeks. Came out, knocked the ball out of the park, upgrades, etc. They're seeing all those key sort of cylinders within the business, overseas expansion. Their technology platform is working. They're winning new customers, and they're actually getting more people in terms of into their offices and more clients. And they were up, I think it was up 60% like for like over that 9-month period at the ending of December. And I think Singers have upgraded their expectations likewise, and now they have a fair value of 197p per share, and I've got a fair value of 180. And really, we're just scratching at the surface of the big opportunity, because when I interviewed Harry Adams, the CEO, I mean, ultimately, they will be looking out at North America as well as their sort of like their bedrock UK. They've put sort of like, toehold offices down in Amsterdam and in Australia, and they're all going well. So we're firing on all cylinders, but the total addressable market is actually frankly enormous. And once they get more of that sort of like straight through processing on that technology platform to meet their customer requirements, then it's going to be all, well, it is all systems go, and I can't see that momentum stopping. So if I was going to advise you and myself about, we've both got sort of good positions, I'd be almost saying definitely hold, but I'd be almost saying if any pullback, I'd be buying some more actually.
Yeah. I mean, a couple of times it's failed at that 140 level, but I think once it goes past that, it'll start really moving. It seems to be some resistance there, some selling coming. I don't know why.
Okay, so you've done pretty well. K3 got bought out. Big win there. Big win on Argentex. Well done.
I know. Ashmore Group, which of course is a fund manager for emerging markets. I quite like that. So I was hearing a lot about the emergence of emerging markets, and in fact, they come up with that update today. And even though up until December, their pretty much figures are halved, they're saying now we're starting to see money come back in, and so it's very positive.
Smart move.
They've rallied about 9%. I've had up 9% on those.
That's basically a China reopening play because the market's come top drawer, hasn't it?
Yeah, and
exactly. Commodities and energy.
Yeah. I bought ASOS after the last trading update.
Did you? Wow, yes. That took a bit of bravery.
Yeah, because they said they've identified 300 million worth of savings, cost savings, all that stuff, and they said they're going to be profitable H2. And I thought, okay, so if they're going to start generating cash now, I mean, this is down 90%, but I also want to see them break a certain level on the chart, so I bought that, and so they rallied them up 8% on those, which is quite nice. These only small positions, like 3% of the portfolio, not massive positions.
I heard just on ASOS, on ASOS. I was on a US earnings call with a footwear manufacturer, which does sort of like outdoor sort of big boots sort of stuff, walking boots, hiking boots and stuff. It pointed out because it uses ASOS in the UK and actually highlighted those out of all of its global distributors as actually overperforming. So just anecdotal evidence of effectively a brand using that vehicle. It's working.
Yeah. So I took my Future PLC before. I bought it on a breakout. I was up profitable until yesterday. So I'm down 4% on that, but I've just got again 3%. They've got that update today, trading statement, which is fine. They're in line with expectations. They say it's a tough market out there, but they've acquired two companies. They're getting better and better at what they do, basically. So MJ Gleeson, I bought. I did watch.
House builder, affordable.
Yeah, I did watch your house building thing with John, with watching that, and towards the end, I think you both said it's worth holding on. MJ Gleeson, like I said, they're pretty much below net asset value. They generate good cash. There are smaller caps of house builder. And the chart broke out, and I thought, okay, it's a thing about saying, okay, understanding the economics of what's happening, but looking at the market, there's net demand for the shares going on here, and it started right. So I'm up sort of 6% on those. One of your good dividend favorites.
No, hang on, just on MG Gleeson, you're in good company there because Christopher Mills of Harwood Capital owns a big chunk of that stock and loves it and has held it for 10, 20 years. And he trusts the management team. They know what they're doing. If you've got a long-term time horizon, I just can't see how you're going to lose money on that one.
Yeah, 4% dividend there. So at the moment.
Yeah. Well done, you're turning into a GARP value investor here, Justin. I'm impressed.
Well, some of them are not. I mean, an old one of yours. And in fact, when you mentioned it a while back, you got in and out of it, right? And I researched and looked at it. They took a bit of a hit recently. Money Supermarket. I got into.
Oh, love it. Yeah. No, I do like it.
I like that. I mean, so you first mentioned it a while back, so I have it on my watch list, but it just weakened, and literally it's rallied like crazy. I've averaged up a bit, but I'm up to 3% on those at the moment. On the beach,
just on Money Supermarket. Let's just add a bit to that, because I have been tracking it. The reason why I sold it was because I thought when they put the price cap in there, I thought it would stop, obviously, some of their energy sort of like value offers, etc., working for at least 18 months. I actually sold it when Liz Truss said she was going to have that price cap for 2 years. I didn't factor in she would only have a lifespan of 30 days and get kicked out.
She didn't either.
and the energy price dropping. And now that because of the energy prices, the wholesale energy prices falling, just dovetailing to what we said earlier on, that whole competitive space, they could play a real part in that once they get rid of that price cap. And I think in April, the government's got a difficult decision, because I actually don't believe their £3,000 a year price cap is actually any economic sense for a consumer. So I actually think what you've just done there is perfect sense, because a huge potential growth and profit driver could come back onto their radar screen later this year. So I think you're right. I mean, and it's cheap. And
and
it could get bought out as well.
Yeah, even in the Q3 trading update, every part of their business was positive apart from that. They said that's hopefully opening back up. So you got insurance up 10%. This is for the 3 months. And in fact, the 9 months, 9%. So overall, they're up 33% on the previous metrics in 3 and 9 months. So apart from that, but I said that's something that can happen going forward, the energy part of the thing. So yeah, so I got into that. Also pay a nice little dividend, don't they? So
yeah, they do. Yeah, very cash generative.
Yeah, on the beach, I quite like, because they raise a lot of money.
Holiday,
they raise a lot of money, and about 64 million they had, and they're going to be profitable again. And I've just seen a lot of their adverts. The chart was looking good. They've been hammered for COVID and all that stuff, but they seem to be getting traction. And going forward, they're going to be they're good margins, like a Portal. I quite like Portals, like Money Supermarket, Rightmove, all that kind of thing. You know, good operating margins, all that stuff. And I just driving. If I was taking my father to the hospital, and on the radio came on the beach, it was over the Christmas period, and I just looked into them again, and I thought, I think they're going to have a recovery. And everyone's around has been saying, we want to book holidays. Holidays is bouncing back. You've had Hayes Travel saying they've had double or triple the bookings they've had in the last year. So I got into that. I thought they're up. Well, in fact, I'm just flat on that. Another
pricing's really good, and volumes are good, aren't they? On that, like it. I like it. Yeah.
Okay.
In fact, you've got ticking the boxes for every single one there.
Okay. Well, this one I'm a customer of, and I'm just looking at the figures. I thought, per week, this company is signing up 24,000 people to their puppy and kitten club, and so I bought Pets at Home, right? Because they've been hammered, and if you look at their metrics, they're doing very well. They're growing all kinds of metrics, and they've got recurring revenue from vets and all that stuff. And I go into these stores, I think, where's the competitors really? Okay, you make it some local little pet shops, and there's 1 or 2 maybe national brands, but nothing like them. I mean, to me, I see them as a market leader completely. I use them. You get loyalty cards, so I thought they are a market leader. They've been hammered. They're down, so I just went. Bought a few of those. What up there? Up 7% on those. In the microcap space, I bought Poolbeg Pharma.
Okay, yeah.
So I haven't put a lot in, but that shot up 24%. It's like that's microcaps for you, you know. But I haven't got a lot in there. Also, Rightmove. I thought I want to get a house builder.
Okay, yeah.
But I've got one in the smaller cap space. I want to get more exposure to sort of real estate. And I thought, do you know what? It's the market leader. It's the big dog. You know. I mean, when you can't fault it. Their margins are fantastic, and it hasn't taken a massive knock. But you're not going to get that. You know. So the only opportunity you can get is right now. So I bought that. Up 3% on that. SCS Group. We've had a chat about these off air, and I remember before you said,
the sofa guys.
Yeah, and I remember you said the valuation can't be right on that. Surely not. The big boys being that, and the big boys are in now. Premier Mighton just got announced they went up about 5% recently on it. So
okay, good.
I'm up 30% on that, and I'm gutted because I didn't put a lot in because I was a bit cautious because I listened to you that he's
don't FOMO it. You've got the thing is if you make a good bit of money, forget I mean there's lots. It's always the same, isn't it? When things go up really high. And you think, I wish I'd put some more in. You've just got to be thankful that you've made a shed load of bread, mate.
Yes, exactly. And I'm expecting a rollover because literally the charts just kept going up. I mean, they're doing a share buyback as well, which helps. But listen, when I bought them, they were literally about 50 million market cap. They had about 74 million in cash. They've got lease liabilities, but they're still cash generating. I thought, this is a good. I'm reading about on their website, and the amount of reviews they have is like got about 400,000 reviews from customers, about 4.8 on was it Trustpilot? So Trustpilot, that's a good company. So and the metrics there are undervalued. And the last one on the bigger cap space, I still hold Truth in XP Factory and G-Tech, but Victoria Plumbing, I bought some of that.
Okay, right, yeah.
Up 20% on that. So I bought up until 2 days ago, I made 14 investments. I was up on 14 of them. Future, I'm down, and now on the beach, I'm down. So there's 2.
That's not bad. 12 out of 14, pretty good.
Yeah. But the future, it's quite volatile. There's a big. I thought it was in a starting uptrend. I think it still is in a starting uptrend, but it does have these days where, like yesterday, a big fund just sold a bit and they dropped like 5-6%.
Well, it's advertising, isn't it? It's digital advertising.
But so I'm happy that I've still got sort of cash.
So what's your year-to-date performance then in January? You must have had a really good bank so far this year.
I haven't had a chance to check that.
Okay, but I bet you're about well over 10%. I'd have thought.
Yeah, well, I've only got 50. I mean, I've only 50% in stocks, so 50% in cash as yet. So it's not going to be outperforming massively.
Oh wow, God! So
yeah,
I thought because you say you were 50% in cash before. So what you've done then is sold some to buy some others. Essentially, you've changed that blend.
Yeah, the small caps I've got now, like I say, is GTech, XP Factory, Trufin. What else is there? Yeah, that's pretty much it, I think. And Poolbeg Pharma. So they're the new microcaps.
Yeah. No, I mean you've got a good diversity over a bunch of sectors there. No, I think that makes perfect sense.
Yeah. I don't intend a lot more. I mean, I've got 15 stocks. Maximum would be 20, but I'll only sort of increase my exposure to companies that start performing well. If they lag, that's another thing. What I've been doing now. Previously, if I'd liked the company and I'd research it, I'd be convinced by it, the fundamentals and where it's going, I'd go in big time and I'd even average down. I realize now that's not the way, actually, because we can all be wrong. And if you go in small, I've been listening to a lot of podcasts, and one of these, I can't commit fund manager, but he's a phenomenal fund manager. And literally, so I never go in above, he's talking about 1% of the portfolio in any company, even if I'm super convinced. Because if it goes right, I'm fine. It'll always pull back a little bit. I can average in. If it goes wrong, it's 1%. That's it. And if it 50, say it takes a 20% knock or 30% knock, that's 20% of 1%. So that's all it is. So unless you're proven right by the market, there's no point going big. It's plenty of time. If it's going to be, if it's going to give you multiple returns over many years, you've got plenty of time to scale up or average up. But averaging down sometimes. And so, of course, so then what happens is, by default, your portfolio is more leveraged to your winners than your losers. So if you start averaging down, you just drag your portfolio. And I have done that in the past. I've been convinced.
Yeah, I just okay. One other way of looking at it. Okay, I get that, right? But if you've actually been, watching a company for a long time and you understand the industry, and you may have been in there, like some in moneysupermarket.com and all this sort of stuff. And I've been following the industry or the company for ages. Then I'll tell you, I normally just go straight in with a full position if I can, get the liquidity. And then I don't average down and then I don't average up. I just let that one sort. And then obviously it depends on news flow. But, so that's the strategy. It comes down to how comfortable you are with taking higher risk on the basis of the knowledge base you have. If you're new to a stock and new to an industry, I can absolutely understand why you want to go small. Learn about, get a little toehold, learn about the company, learn about the industry more, because then you get more comfortable and you can sleep at night. But sometimes, certainly in the small caps, it's difficult to get. If the liquidity is there, then it's usually worth pulling the trigger. Well, I do anyway. If you know a lot about it and you've been tracking it, let's be clear about it. There's lots of companies I own that I've or had for 3, 4, 5 years. So there's no way. Basically, I've got a pretty good feel about those businesses and what the risks and rewards are about it.
Yeah, where I'm coming from is that microcaps have really, hammered me, and I'm thinking, okay, let's be a bit more sensible here, rather than go big time, especially because we're still in a volatile situation. It's still bear market, or it's coming out of a bear market. There's still going to have volatility. So, like I said, I want to be sure on these companies before I plow the lots in. Like I said, every company I do, I will do. I run it through my spreadsheet. It's got so many metrics there. Check all the the margins, everything like that for valuation rates, and then I look at the chart. But even then, you can sometimes I've done it before. I've invested, and all of a sudden you get a big seller come in and knocks it down by the like, what? So maybe I should. And so those things you can probably take advantage of. So it's just coming from an area of being a bit risk averse now, because I'm taking a bit of a knock in microcaps. So I'm now thinking we've got this. If we start in a bull market, it's going to be here for 3 to 5 years, pretty much. There's plenty of time, we're not going to jump off the bottom,
Yeah, personally, I don't think we've started a bull market. I think what it is we've extended effectively the rally. I think what you've just said in terms of there's going to be a trading range, it's just going to be a stock pickers market until basically the interest rates start coming down. And I can't see, if the economy keeps rolling, I can't see how the interest rates are coming down. So eventually something is going to crack, and I suspect those cracks are going to start to appear in the second half, and it's going to upset the apple cart in 2024. So I love what you're doing, because you're being more defensive, you're being diverse, you're basically giving yourself more liquidity. And frankly, I think that's the best strategy. Obviously, from my own personal perspective, I've got a lot more equity exposure than you have. I mean, I'm not 50% cash. I'm 8.5% cash. But I will be getting, I've got near cash because I've got some, Crest Chick being bought out, which I'll get some big chunk of funds. And I've got another one, Amrit Pharma, which has been taken out, and I'll have that sort of like first half as well. So I'll have plenty. And I personally have also started to be looking at opportunities, but I haven't got that much available cash at the moment. And the one I have, I've actually just bought a big cap. I've been watching it for some time. I know it's you might think it's boring, and it is. But I need a bit of solidity.
Boring is good though sometimes. Isn't it?
It's right. Yeah, boring. Boring is me.
Yeah.
It's Pfizer. So I know it's been a massive.
Okay.
I know it's been a massive winner in terms of the COVID, but that's now dropped out the share price in terms of the valuation going forward. They put out their earnings expectations last week, and they were a lot less than people were expecting. So the shares have dropped down to about $44 per share. And if you put that through the sort of like the PE multiple, because they're on sort of trough earnings this year, it works out about 13 and goes to 11 times PE for next year. Not expensive. They pay over a 3% dividend yield, which is obviously good. I'm putting it into my SIP. So basically what that means is because it's a trust structure, I don't get withholding tax on that dividend income either. And what I really like about it actually is that their pipeline is actually really good. And they could see over 6%, compound like-for-like growth up until 2030, and that will drive really the top line. They've got brilliant technology in terms of, basically the vaccine side, mRNA through their BioNTech sort of joint venture. They've got obviously Paxlovid. They've got muscular dystrophy, ulcerative colitis, autoimmune. They've got stickle. I mean, they've got 16 drugs which are in registration with the FDA. So they've passed phase 3, which will be launched in the next 12 months. They've got another 20 odd, which are basically in phase 3. So they've really got a late stage pipeline that's going to drive that top line. And that's what I love it. And if any of that comes through, and they've got a migraine drug also that could do really, really well. So I'm absolutely, I love it. And I think it's a very, very liquid stock. It's a dollar generator. It's a world leader in what it does. It's $250 billion. And it could buy businesses as well. And the bit of M&A with it, I haven't heard anybody talking about, but I would love them to do, would be to pick up BioNTech and grab that mRNA technology that they have and integrate it not just in their vaccine platform, which is already there, but also in their autoimmune and their oncology franchise as well. And that could just be an absolute game changer for them. And it'd be a large piece. It'd be a large purchase, about $50-60 billion if they bought it out. But they could do it. There's no doubt about it. And anyway, so it isn't.
How much? Go on.
It's good. It's basically good defensive long-term GARP large cap winner in my view, that I'm not expecting a massive return, but I could easily see over the next 5 years this goes to $80 from 44. You could get 10 to 15% per annum total return off this one if they can actually deliver on that pipeline, which it's near term as well. It's really good. I went for my sunny walk on Sunday, and I was listening to my podcast on Spotify, which was the earnings call for Pfizer. And I basically thought, right, okay, I want to pick some up, but I didn't. I've only been able to use the spare funds that I have in my SIP, and I'm waiting for in a month's time to be able to pick up a much bigger chunk. Which, if I had the cash now, I would have done already.
Yeah, and do you know what? At the moment, they're literally oversold on what's called a relative strength.
They are,
I know.
Normally, they're cheap.
And then normally they bounce from that. Previously they bounced from that a couple of times, So
they're in the. I mean, basically, what's happened is that last year they had an absolute blockbuster year. They delivered $100 billion of revenue, $6.50 per share of earnings, which was on the back of obviously their COVID vaccine and their antiviral Paxlovid. They also had on the back of that, which zooped it up a bit, was there was a lot of forward ordering from governments and from, say, in the US, etc., which means that they've stockpiled stuff into. So that means they're going to get a decremental sort of like you have to get through that inventory held in the channels to remove. So they're going down from 100 billion to about $70 billion this year. And I think they're guiding to about $3.30 or $3.35 is the midpoint for their earnings. But it's going to hit, we go back to $4 once that normalizes in 2024. And as I say, $44 on a top quality big pharma with a great pipeline, generating at least $4 per share with a good income and zero debt on its balance sheet. I mean, it just looks like a no-brainer to me for just defensive, sort of like healthcare companies. I mean, I can't personally. If I could hold that for 10 years, I will, because why not?
Yeah. And just a question on research here, because I generally I look at headlines on US stocks and stuff, the big ones, and my son's hold a few, not a lot, but I mean just to keep them interested in stocks and shares. How many companies you look at? To me, I tend to focus and limit my research on UK stocks because there's so many there anyway. How do you keep an eye on all those stocks? I mean, US, UK as well.
You keep asking me, I don't sleep.
Yeah, that's the answer. Yeah.
No, I mean, to be honest, I've been doing this for 30 years. Okay, so I know I know quite a lot about the stocks in the UK. Yeah, and so a lot of my interest does go into the States, but I regularly, I'm listening to podcast earnings, looking at results, CNBC, Wall Street Journal, Barron's Magazine. I mean, you wouldn't believe how much my inbox gets in with sort of news wires and stuff. And then obviously I think and have a good view. So how many stocks do I look at in a year? I mean, literally thousands, mate. Absolutely.
Yeah. Well, it's funny. I was thinking, I literally, for many months, I've done financial research on at least one company a day, and you realize we do that pretty much. That's 360 companies a year. And even now, like I said, I've been in the market for many years now, but even now I come across companies sometimes I've never heard of. How have I heard of that yet? It's nuts, isn't it?
Yeah, no, I do as well.
3,000 stocks, whatever it is in the UK, is still a lot. And you think, I should have heard of that. I haven't heard of that, So it's nuts, isn't it? I mean, out there. So I just think there's lots of opportunities in the UK, but I deliberately don't go to the US, even though there's some better growth over there. Or they rally stronger, because I just get option paralysis. I have too much stuff to look at,
you want more. Now,
you need less sleep. You need less sleep. 2 hours a night sleep is all you need. Yeah.
Sleep's a whims. Now, let's move on to a topical issue. I wanted your thoughts. GTP and generative AI. What you thought? Is that overhyped or is that actual? I mean, let's be clear about it. Microsoft just put 10 billion quid into ChatGPT, so it may be overhyped, but actually there's real money behind it.
Yeah, well, do you know what? It's funny. I went on the website about 2 days ago, and I was scared to put anything. I'm not another associated with Bing now.
How to be a stock picker? I bet put that as a question.
But literally, he said, start with us now. I thought, and I was scared to go any further. I thought, no, hang on. I'm not going to sort of give my computer details to this artificial intelligent robot. I don't know what will happen. So it's a bit worrying, but it's been going on in the background with lots of companies for a long time. Even if you Google and stuff, they use it. And even if you on emails and stuff, they'll fill in stuff and all that stuff. They'll also give you suggestions. So it's there. It's growing. I think it's funny how in Facebook's last, or Mark Zuckerberg's last call, he talked more about AI than he did about Meta. And you realize,
I don't think he even mentioned Meta, did he?
Yeah. So you realize that's the powerful thing for the future. Where, actually, rather than people putting boxes on the head and pretend they're cartoons in a silly world, that's not going to happen. Let's be honest. But when it comes to being useful for people, AI is the way forward. I don't know how powerful. I don't know much about it. I know it's been this buzzword for a long time, but I think it's only going to get better, isn't it? As computers get better as well. But what's your thoughts? I know you're into it.
Yeah. I mean, all I would say for investors, and this is a couple of broad rules. I mean, I'm not a flipping, AI, expert, etc. But the basis, how good that AI is obviously always difficult for investors to actually interpret and to understand. The key thing that I would use, the KPI, and that the big factor is the quality of the data set that they have access to. Okay, so if it's a really deep and broad data set that they have, then you've got a good chance of overlaying, obviously, the computer algorithms and the programs over top to be able to get really good results. So it'll always look at the quality of the data set, then actually split it down. Is it proprietary data, or is it public data? Now, the big incumbents, the likes of Google, Facebook, and obviously Microsoft and this sort of stuff, they've got a combination of public data and a lot of their own data because they've collected from their users. So they're going to be really tough people to beat in the AI space if they can get the programs, which I'm just sure everybody able to do. So when it comes to deciding whether it's hype or reality, look at the quality of the data set. And if you've got somebody who's coming out as a newbie into the market who hasn't got a very good data set and hasn't hooked up with Microsoft, Facebook, or somebody like that then absolutely just, I would just say that is just hot air to me, because they're not going to be able to execute it. The areas that are really deep into AI, which we haven't heard about at the moment, healthcare. Wow. I mean, when it comes to sort of like, effectively new drug discovery, gene therapy, when we come to see, look at patient treatment sets and personalized medicine, that information, particularly hooking up with the likes of the NHS or the huge group, will be massive, because you'll have proprietary data that effectively you will get exclusivity on the back of it. So anything like that makes a lot of sense. Now, the other side to go into it is looking at the picks and shovels boys into AI, okay? The people who are going to give them the influence. It's like, the test tubes and all this sort of stuff. Obviously, Nvidia, which does all the graphic processing chips, which is the parallel processing, is just going to have a boom time. The problem is it's not cheap. Nvidia's doubled in the last month on the back of things like ChatGPT. So, you're not going to get a bargain there. But when I interviewed Stephen Yu from Blue Whale 2 days ago, and everyone can have a look at that, the video and stuff like that. That Nvidia is his number one play, largely on the back of the growth in AI and how that's important. So that's going to be one picks and shovel. Another picks and shovel, which I actually do own, and I've double checked this with the company, is FD Technologies. And the reason why it's a AI play or picks and shovels AI play, because of its KX Insights business that does effectively it analyzes and mines huge quantities of data in real time for the financial community, for the algos and for all the hedge funds and the merchant banks so does 19 of the top 20, for instance, of the big merchant banks. And that's where its core is, but it's also branching out into IoT and into things like Formula One with McLaren, anywhere where you have massive data sets and huge requirements in terms of real-time processing. It is an absolute expert and has got a sort of like an agreement with Microsoft Azure. This company with AI is going to be one of the picks and shovels, because AI, to run its algos, is going to need this type of platform to be able to give it the information. Because effectively, you think about it, you've got raw data, that's useless. You then ingest it, you then effectively, manipulate it to give you information, which is what KX Insights does. And then you push it into the AI platform that makes decisions and learns from those decisions and the outputs to get better decision making. So this one could be an absolute gold rush for them. I mean, I have checked it with the company, and they agree with what my view is. So I think this could be an absolute home run. This one, this AI could really, really jumpstart the valuation of FD Technologies. But anyway, that's me. But I don't want to get too.
And chip makers as well, chip guys as well. You think it's going?
Yeah, I think. Well, okay. I only know about Nvidia because it's got the world's best GPU, which is a graphics processing chip, which basically is the powerful chip that allows you to process parallel. Because most things like Intel and AMD have CPUs, central processing units, which are basically just serial processors, and that they're just massively slower than AI. And for AI, that's why they can't be used. That's why you've just seen Nvidia go to the moon, and it's on about a 90 times PE. It's not cheap, but it's a quality business. I mean, that, and you can understand why. So yeah, interesting that one.
Well, very interesting. Poolbeg Pharma I own not a lot of, but I mean, they did a collaboration recently with an AI company that specialized in medtech, and they identified novel RSV drug targets using AI. And so that's they said, and they can compute. So he said, well, generally we got so much data we can't compute it, but this company can. And phenomenal amount of it. Just on
that RSV, okay. That's a really quite competitive space. I know a lot about it from Pfizer, okay. And they're putting out a RSV vaccine, this year, and they're going head to head with GSK's RSV as well. And all I would say is that is a massive, massive market, and you'll get lots of people, sort of like benefiting from the back of it. But I suspect the lion's share is going to come from the likes of, Pfizer and GSK, who are launching this year, and Moderna, I think, are putting an RSV out there for mRNA. So I think the whole vaccine.
This POLB, one of the first candidates is POLB1. It's got it's read across to many different applications. They've even discovered now it could be used in oncology. So it's very exciting. What I like about Poolbeg, they're the capital light. They literally get up to a certain level, pre-licensing, and they'll farm it out to or collaborate with a bigger company. But what I like about it is they burn very little cash. They've got a lot going on. They've got about 20 million in cash, and they burn very little of it. And they've got so much stuff going on. So they're saying it's one of the, for me, it's what's called, hope pipe potential stock. They've got to have lots of cash. They've got lots going on. They've got to be in big markets. And that's what Poolbeg are. And they're so busy. They're on the podcast every week doing new things. So I think something's got to come of this. Something's going to happen. And they've got plenty of cash runway, like years of cash runway, So it's I quite like that. Yeah.
Yeah, no, I've looked at the technology. I think it's really, really good. I mean, just on that sort of like the healthcare theme, I mean, it's a bit bizarre, to be honest, with lots of things going on. You've got Avingtrans, and they're obviously, as we talked about it, as sort of like a very defensive sort of engineering company with long-term secular trends in terms of sort of like, the nuclear side, the defense side, with the, and obviously blast-proof doors for HS2. So you've got your storage boxes for Sellafield. So, but they've also got a fledgling and a really promising healthcare division. And one of their investments in that, Adaptix, they own 12%, and they've also got I think it's a £2 million convertible in there. So effectively a higher equity. Adaptix, who are doing a small form X-ray scanner for sort of like hands, and I think for sort of feet and elbows and stuff like this, state of the art, cheap, and which can go into point of care. They got FDA approval like 2 weeks ago. Fabulous. And so what they're going to do is they're going to soft launch it in Q2. They're going to manufacture it initially volumes in Europe, and then get a manufacturing place out, a contract manufacturer ultimately in the States and stuff, and then probably hard launch it once they've got the distributors in place towards the back end of this year. I mean, that is fabulous. That is, I mean, FDA approval for a really revolutionary new device. And what that also does, it sets a blueprint for their commercialization strategy of their largest subsidiary, which is Magnetica, which is doing a small form MRI scanner, and that will seeking, I think, FDA approval sometime next year. So it's about 12 months behind it, but it really does put a lot of upside for this potential healthcare division. And then the main sort of like stalwarts, which is generating all the cash. They've still got, I don't know, £15 million worth of cash. They're coming out with their interims, I think, in a couple of weeks' time, so I'll get a chance to actually update them. But it all seems to be trading well, and they've got huge revenue cover and visibility. I think 90% of their revenues are already booked for 2023. So you've got a really solid, cash generative, high margin, niche engineering business. And then you've got this really upside option of the healthcare, which I don't think is in the price at all, but is really gaining a lot of momentum. So interesting. Another top quality company that, I'll tell you, if I had an opportunity, to put a chunk in, I would do, and I wouldn't have any hesitancy of just dripping in. I'll just put here's a 6-7% stake in there, of my portfolio straight in there, but the problem is for me, I just don't get that liquidity every day.
No, look at the back of the chart since 2010, right? It rallies.
Yeah, I know.
FOMO. It rallies for 4 to 6 months, has a breather for 6 months, rallies again 4 to 6 months, has a breather for 6 months, and keeps doing that. I mean, any big dips like the dash for cash crash is an opportunity, So
another one where you've got a bit of momentum in the healthcare space. Venture Life came out with a trading update. I think they've got their results probably sometime March, April time, and they've started to sort of move up. The shares are over 40p. They came out with better, well, it basically said at least in line on EBITDA expectations for the year. But what I was really interesting. I mean, I had a chance to actually interview the CEO, Jerry Randall, and they've got real momentum in that business because their like-for-likes picked up significantly in the second half compared to the first half. They've got a really large order book. I mean, the order book has been about over double what it was from last year. They've just made that acquisition as well, which should help the growth even further. Margins are tracking up as well, gross margin, because more of their products are actually made in-house rather than brought from third parties. So that one really is firing on all cylinders, and it's still cheap. I mean, Singer's the house broker have got a 72p valuation, and I've done it on a 13 times EBIT for this year, and I think this is the EBIT margin has got real tracking, can really track up as well. So this is on sort of like conservative EBIT margins. I've got 71p, so and I think the shares are sort of like less than 45p, but they have started to move up. They have started to move up. There's plenty of upside there.
Well, to me, that when you see a big update, back in the 1st December, they did a trading update and an acquisition. It did 28% in a day. When you see a big move like that, it went through the 200-day moving average, and it's continued to move. I mean, there's a good-looking chart there. It seems like a start of an uptrend there, definitely. Yeah.
Yeah, and another one really dovetailing with what you've said earlier on in terms of your Victoria Plumbing and all your housing, because what's really interesting actually is that obviously we had that moment of Liz Truss with her economics, which just sent the gilt yields massive and the bond markets into a tailspin, and the pensions sort of like funds having to be bailed out by the Bank of England. But that was like the worst case, which then knocked all obviously the air out of the house builders and that whole building product sector. But what's happened now is slowly, as the market's readjusted and it's got a bit more calm associated with that, gilt, effectively the yields on mortgage rates and on sort of like the gilt yield have started to fall, and so your house builders have started to move back up. And another one in that area, which goes to you, is Lords Group Trading. I mean, it's basically a UK builders merchant and plumbing heating business, and that started to move up as well. And they put out a trading update, all in line. Things are moving forward. They've just bought their free real estate round Heathrow. They've just done a bit of corporate tidying up. They sold one of their more sort of like domestic focused divisions as well for about £1 million. But they're resilient. 80% of their revenues come from repair, maintenance, and improvement rather than new build. And they're not seeing any signs of a slowdown, actually. I mean, in fact, if anything, their like-for-likes increased into the second half compared to the first half. Some of that was obviously a catch-up because they had supply issues in the first half in terms of the boilers. But they saw also faster growth in their traditional sort of like, builders merchants operation. So not stupid. I mean, it's very much the same as Victoria Plumbing, but in a slightly different.
Yeah, but the thing is I've out of 15 stocks, I own 4 retail. I thought, am I too overly exposed to retail? But the only reason why I'm in them is that they have been hammered and they're good businesses. And people are so scared of retail, but that's where bargains are. Just look at the businesses. Are they doing well? Are they cheap? And they are. And so if you look into longer term horizon, they're going to recover. They've been oversold, many of them, So
and importantly, the quality of the management team has been tried and trusted through downturns. I mean, here we've got sort of like, Shankar Patel. I mean, he's been running that business for 20, 30 years. So he's been through the great financial crisis and the dot-com blow up and, basically the pandemic and Brexit. And every single year, they've taken market share from their competitors, from like Travis Perkins, and the total addressable market is still very, very large. So, I mean, isn't that if anything, the tougher competitive environment has made their position even stronger, actually, on the ground. And they've got a very entrepreneurial team, which is the key for that long-term longevity of of that sort of successful platform.
Yeah. Just want to talk about XP Factory for a little bit, because they did a trading update, and they were saying that they missed their top line by about 2 million because of the strikes going on, in
London.
In London, and that was their busiest for a week. But nevertheless, they've opened 27 boom battle bars. They've gone from pretty much 6 million in revenue to 22 million in revenue, and they're on for like close to 40 million next year. I'm just hope this company can have a free run at it without COVID, without strikes. And I'm thinking they've got to sort the strikes out this year, because I mean, already the Conservatives on the back foot. If they don't sort the strikes out, there's no hope of them getting in the next election whatsoever, because they've been going on too long. Something has to be done, doesn't it?
Yeah. Well, I mean,
who knows?
Yeah, luckily we can all work at home, but it isn't good for people like Boom Battle Bars and an XP Factory, no doubt about it. But
even with that, I mean, Richard came on the podcast. Even with that, he said most people had postponed. They're having Christmas parties in this quarter,
Yeah,
so it's not a bad thing. It's just pushed out. But I think an amazing year of growth there, and now they've got all these places open. Operationally, they're getting more efficient. They're getting more well known. So it's just the start. But I think they've done so well in the first year. Now, of course, going to be profitable going forward. They've got cash. Yeah, I just like it a lot. And what's annoying? Go on.
Just on your XP Factory. I'm actually interviewing Paul Scott in about 2 weeks time. He loves XP Factory, so I'll get his latest views.
Yeah, and in fact, I got my 21-year-old nephew's views. I went to stay in my father's house for a couple of weeks, sort things out, and he was saying, "I love Boom Battle Bar in Cardiff. All my mates go there." I said, "What? Why is that?" He said, "You can talk to girls." He said, "It's easier because you're playing. You're playing a game.
Yeah,
true. Talk to them. And they said, "You want to have game girls? Or invite them into your game and stuff." And it's easy to break the ice. I said, It's a very good angle, that. And
he's a chip off the old block.
Yeah, exactly. I tell you what's annoying, it's gotten down. I know I don't hold at the moment, but I do want to get back in. This Polarean, they've had sort of exclusivity for 5 years on their technology, their FDA approval as well. But the share price is just not reacting. It's so annoying. Hang on, they're achieving. So I don't know what's going on there. I'm just sitting back and waiting. So I believe they've got excellent technology there that's globally significant. But it's so frustrating.
Have you seen any research on that since they got FDA approval? I mean,
no,
nor have I, and that's really odd. Actually, I'm really surprised that they didn't have other people shouting about it. But hey, if I was going to say one bit of advice to the company, get some research out there, or get a video or something like that. Do something that we can understand what the commercialization sort of like landscapes like that whole, because I'm with you. I think it's a quality business, great technology, huge addressable market. And the shares are down. It just doesn't seem to smell right. So what I would say, I think
what I'm hoping is they're in talks with a big MRI manufacturer. That's what I'm hoping. That's why they're not. That's why. Well,
get them to say it.
I know. That's what I'm hoping there. But anything else? Paulie?
No, that's great.
Cool. Marvelous.
Take care. Well done.
Yeah. Speaking of 2 weeks' time. Cheers, fella.
Bye.
Bye.